Most people still believe one thing, that owning a home means you made it, that it's the safest move, the smartest move, the American dream. But in 2026, that belief might be costing you everything. Because right now, people are upgrading from rent and accidentally locking themselves into a financial trap. I'm talking about going from $4,000 a month to $6,000 a month and calling it a win. No one forced them. They chose it. And what they don't realize is that extra $2,000 a month isn't just a higher payment. It's lost investments, lost freedom, and potentially hundreds of thousands of dollars gone over time. So the real question is, are you building wealth or are you buying a burden? Because today, we're breaking down why in 2026, home ownership might not be an achievement anymore. It might be a punishment nobody warned you about.
The American dream was sold to you. For decades, people have been told one simple idea. If you own a home, you've made it. It sounds harmless, but the truth is that belief didn't just appear naturally. It was built, promoted, repeated over and over again for nearly 50 to 80 years. Buy a house, settle down, build equity. That's success. And if you don't, then somehow you're falling behind. But here's the part almost nobody questions. You don't actually need to own the place you live in to live a good life. You just need a place to live. That's it. And yet millions of people today are still chasing ownership like it's a finish line, even when the numbers don't make sense anymore. Take this real example. A couple in the Northeast was renting for about $4,000 a month. Not cheap, but manageable. Then they decided to buy a $1 million home. Their new monthly payment? $6,000. That's a 50% increase. Same lifestyle, same location, just a different label, owner. And suddenly, they're paying an extra $2,000 every single month. Now think about that for a second. No one forced them to do it. There was no emergency, no deadline, just one feeling, fear of missing out. If we don't buy now, we'll never be able to. So they locked themselves into a bigger payment in a market that's already stretched and convinced themselves it was the smart move. This is where the shift happens, because what used to be a milestone is quietly becoming a burden, not because owning a home is bad, but because people are making the decision based on emotion, not math. And once you cross that line, it's very hard to go back, because now you don't just have a home, you have a commitment, a fixed cost, a long-term obligation that follows you for decades. So before you even think about buying, there's one question you have to ask yourself. Are you chasing a dream, or are you following a script that was written for a completely different economy? Because what comes next is where the real cost starts to show, and that's where the real problem begins. Because the biggest cost of buying a home today isn't the mortgage payment people see. It's the wealth they never build because of the money they lock into that house. And once you understand that, you start to realize that homeownership in 2026 may be costing far more than people think. The hidden cost nobody calculates. When most people buy a house, they focus on one number, the monthly payment. Can we afford it? Can we make the mortgage? Can we handle the down payment? And if the answer is yes, they move forward. But that's where the biggest financial mistake happens, because the true cost of buying a home is not just what you spend, it's what that money could have become if it had been invested somewhere else. Let's go back to that couple paying $4,000 in rent. After buying, their payment jumped to $6,000. That extra $2,000 a month may not sound catastrophic to a household earning decent money, but over 1 year, that's $24,000. And over 10 years, that's $240,000. That's $250,000 being redirected away from building wealth. Now imagine if that same money had been invested instead, month after month, year after year, in the stock market, in index funds, in assets that historically compound over time. That $2,000 a month wouldn't just disappear, it would grow, and over decades, that difference becomes massive. This is what most buyers fail to see. The house payment isn't just a payment, it's an opportunity cost.
Every extra dollar going toward mortgage interest, property taxes, insurance, maintenance, HOA fees is a dollar that isn't compounding somewhere else. That's the hidden price of ownership. And this matters more than ever in 2026, because today's buyers are entering the market at the most expensive point in modern history. Higher prices, higher interest rates, higher insurance, higher taxes. Everything costs more. That means new homeowners are dedicating more of their income to housing than existing homeowners ever had to. This is what analysts call the new homeowner penalty. Recent buyers are spending around 26% of their income on housing. Existing homeowners? Closer to 20%. That 6% gap may not sound dramatic, but for the average household, that can mean roughly $5,000 more every year just to own. $5,000 every single year. That's money that could be invested, money that could build reserves, money that could create freedom. Instead, it disappears into the cost of ownership. And the dangerous part is, most buyers feel proud making that sacrifice. Because culturally, we've been taught that owning a home automatically means building wealth.
But owning an expensive asset does not automatically make you wealthier, especially when that asset demands more and more cash from you every month. In many cases, people feel richer because they own a home while becoming less financially flexible every year. That's the trap. You look successful on paper, but in reality, your money is trapped. Your options shrink, your ability to invest shrinks, your margin for error shrinks. And over time, that pressure compounds because the more income that goes toward housing, the less income goes toward wealth building. And that's why so many people feel house rich but cash poor. They own the dream, but they lose the freedom. And in the long run, freedom is often worth far more than ownership. Because wealth isn't about having the biggest payment. Wealth is about having the strongest financial position. And if buying a home weakens that position, then the dream may actually be setting you back. That's the part almost nobody talks about. Because while buyers are celebrating getting the keys, they may be walking away from the very wealth they hoped to build. And once you see that hidden cost, the next question becomes even more important. Why has buying become so expensive in the first place? Because when you look at the numbers, the math behind today's housing market stops making sense very quickly.
The math is completely broken. So let's stop talking about feelings for a second and look at the numbers, because this is where everything starts to fall apart. Over the past several years, home prices have surged, roughly 20–25% higher than just a few years ago. In some markets, even more. Now, normally that wouldn't be a problem if incomes were rising at the same pace, but they're not. When you adjust for inflation, the average household income has barely moved. In some cases, it's effectively flat. So think about what that means. You're trying to buy an asset that's 25 to 40% more expensive with money that hasn't grown. That alone should tell you something is off. But it gets worse. Because it's not just prices. Down payments have increased dramatically too, up around 30% compared to a few years ago. So before you even get the keys, you need significantly more cash up front. And then there's the biggest factor everyone talks about, interest rates. Back in 2021, mortgage rates were around 3%. Today, closer to 6.5%. That might sound like just a few percentage points, but in reality, it completely changes the game. Because higher rates don't just increase your payment, they massively increase the total cost of the home. You're not just paying more for the house, you're paying more for the money. And when you combine all of this, higher prices, higher down payments, higher interest rates, you get a market where affordability collapses. That's why so many people feel stuck right now. They're not imagining it. The math
genuinely doesn't work the way it used to.
But here's where things get even more misleading. You'll often hear headlines like, "Home prices are still rising, market remains strong." But those headlines don't tell the full story, because the way prices are measured can be very deceptive. Most people look at the median home price, the number right in the middle. But here's the problem. Right now, a large portion of the homes being sold are on the higher end of the market. Wealthier buyers, cash buyers, people less sensitive to interest rates. So when more expensive homes are selling, it pulls the median price up, even if the majority of homes aren't actually increasing in value. In other words, the market looks stronger than it really is, not because everything is going up, but because of what's being sold. And that creates a dangerous illusion. It makes people think, if prices are still rising, I need to hurry. If I don't buy now, I'll be priced out forever. But that urgency is often based on incomplete data, because underneath the surface, cracks are already forming. Demand is weakening, affordability is stretched, and more buyers are quietly stepping back. So when people say housing is expensive because of interest rates, that's only part of the story. The deeper issue is this. The relationship between income and housing cost has been completely broken. And when that balance breaks, something eventually has to adjust. Either incomes go up or prices come down. But until that happens, buyers are stuck in the middle, paying more than ever for less financial flexibility than ever before. And once you understand that the math doesn't work, it leads to an even bigger question. If affordability is this bad, why haven't prices fallen more already? Because what's holding this market up right now isn't what most people think.
The market is being propped up. If the math is broken and affordability is stretched to the limit, then why haven't prices collapsed? Why are homes still so expensive? The answer is uncomfortable, because this market isn't being held up naturally anymore. It's being supported artificially from multiple directions. Let's start with sellers. A lot of homeowners today are stuck in the past. They remember 2021, 2022, when homes were selling in days, bidding wars everywhere, prices going up every month, and they're still expecting that same outcome. So what happens? They list their home at a high price, no offers come in, and instead of adjusting to the market, they pull the listing, wait a few months, and try again. Same price, same expectation. This is why you're seeing so many homes get delisted and then relisted later. Sellers would rather wait than accept a lower price, and as long as they don't sell, they don't realize the loss, so prices stay artificially high. But that's only one side of the story. The second force holding this market up is something much bigger: family money. Right now, a massive percentage of buyers are getting help. Not small help, significant help. We're talking tens of thousands of dollars, sometimes over $100,000. Parents helping with down payments, co-signing loans, paying off debts, even covering furniture and moving costs. In fact, a majority of parents are either already helping or planning to. And here's the key detail. A large portion of that money isn't a loan, it's a gift. Money that never has to be repaid. Now, think about what that does to the market. It allows people who normally couldn't afford to buy to suddenly enter the market. It increases demand without increasing real earning power. And when demand is artificially boosted like that, prices stay higher than they should be. This is very similar to what happens when governments inject stimulus into the economy. You create buying power that isn't organically there. And the result? Distorted prices, a market that looks stronger than it actually is. But underneath all of this support, there's a problem. Because even with stubborn sellers, even with family money flowing in, the market is still slowing down. Transactions are dropping, buyers are hesitating, and inventory is quietly rising.
That tells you something important. Even with all the support in place, the system is starting to crack. And when a market needs this much help just to stay where it is, it's usually not as strong as it looks. Which brings us to what's happening right now. Because while headlines are still trying to keep confidence high, the real data is telling a very different story.
The market is quietly freezing. If you only read the headlines, you'd think everything is fine. Demand is strong, buyers are coming back, sales are picking up. But when you actually look at the data, a very different picture starts to appear. Let's start with something the media loves to highlight: pending home sales. You'll hear things like, pending sales are up this month. And technically, that's true. But here's what they don't emphasize. This happens almost every year. Spring always brings a seasonal bump. More listings, more activity, more contracts being signed. That's normal. What actually matters is what's happening year over year. And when you look at that, pending sales are still down, which means even with the seasonal boost, the market is weaker than it was last year. And it gets worse, because pending sales are just contracts. They're not completed deals. And right now, cancellations are rising. More buyers are backing out before closing. So even if contracts go up slightly, it doesn't mean those sales will actually happen. Now, look at the numbers that truly matter. Closed sales, the deals that actually go through. Those are down even more, roughly 3 to 4% lower than last year. So fewer people are actually buying homes, not more. That alone tells you demand is weakening. But the supply side is where things really start to shift. New listings are rising fast. In a single month, they jumped over 20%, hundreds of thousands of homes hitting the market at once. And when supply increases while demand weakens, pressure builds. That pressure shows up in one key place: prices. Not the flashy headlines, not the median sale price, but the number sellers don't want you to notice: listing prices. Those have been declining for several months in a row, quietly, consistently.
And that's a leading indicator, because sellers always adjust first. They cut prices to attract buyers, and eventually, sale prices follow. This is how a market shifts, not with a crash overnight, but with slow, steady changes under the surface. More listings, longer time on market, more price cuts, fewer buyers competing. And when all of those happen at the same time, power starts to shift from sellers to buyers. In fact, a majority of markets right now are already moving in that direction, becoming buyers' markets, or very close to it. And that changes everything, because for years, buyers had no leverage. They had to overbid, waive inspections, rush decisions. Now, that dynamic is fading. Homes are sitting longer. Negotiations are coming back. And in many cases, buyers finally have options again. But here's the part most people still misunderstand. This isn't just about inventory anymore. In the past, you could look at supply alone and know who had the advantage. Today, it's more complex, because even in markets where inventory is still relatively low, if homes are sitting and prices are being cut, that's still a buyer's market. Because what really matters is this: are there more people trying to sell or more people willing to buy? Right now, the balance is shifting, and you can see it clearly if you know where to look. Watch the price cuts. Watch how long homes stay listed. Watch how often deals fall through. That's where the truth is, not in the headlines, not in the spin, because while the narrative says the market is holding up, the reality is it's slowing down, quietly. And when a market slows down like this, it creates something we haven't seen in years: leverage for buyers. Which leads to the final question. Now that the market is shifting and the risks are clearer than ever, should you even be buying at all?
Are you buying a home or a burden? So after everything we've covered, it's not about saying don't buy a house. It's about asking a better question. Why are you buying? Is it because the numbers make sense or because it feels like the right thing to do? Because in 2026, those are not the same thing. Buying a home today means committing to higher costs, lower flexibility, and less room to invest. And for some people, that trade-off is worth it. Stability, control, a place that's truly yours. But for others, it can quietly limit their future, locking up cash, reducing options, delaying real wealth building. And with more supply likely coming in the years ahead, the decision you make today may not age the way you expect. So before you jump in, take a step back and look at it clearly. Are you building a life or locking yourself into a payment? Because owning a home is no longer an automatic win, and the smartest move right now isn't following the crowd, it's understanding the trade-offs better than everyone else.
If this video helped you see the housing market from a different angle, make sure to hit subscribe and turn on notifications because the next few months are going to be critical. I'm breaking down where prices are actually falling, where buyers have the most leverage, and how to avoid the biggest financial mistakes right now. Also, drop a comment below. Would you still buy in 2026? I read every single one. Would you still buy a home in 2026, or are you waiting? And if you made it all the way to the end, I genuinely appreciate your time. Thanks for watching, and I'll see you in the next video.